Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct, or today should I say Melbourne Direct, as I've headed south to catch up with the financial community down here. Now, a weak labour outlook for the Australian economy could force RBA naysayers to eat their words. For more, I caught up with IG Markets. Evan Lucas, great to see you again. Thanks very much for welcoming us to the Melbourne office.
Thank you for coming.
Okay, so unemployment has come out on this Thursday. Worst figures since 2002. Walk us through some of the statistics here.
I think, again, you've got to have a look at what's going on inside the statistics as well. The employment change is the one to look at. Now, we know for at least the last 6 months that the ABS has been battling through seasonality issues as well. So I think that needs to be put into context. We saw 41,400 full-time jobs lost in the last month compared to an add of almost the same amount in the month before. We saw an upgrade of the month before to 41,000 jobs added compared to 37,400 for a net total for this month of a loss of 12,200 jobs. So the employment change is very erratic. If you look at trend, however, and that's what you need to look at. Take out the headline figures, look at trend. There is no doubt that the unemployment rate is moving higher, and that employment as a whole and the employment change as a whole is moving to the downside. So the headline figures, as bad as they looked and as terrible as they were, trend is that they are currently losing roughly around about 5,000 jobs a month, which is probably about correct considering you can take seasonality in or out. Then it brings you to that unemployment figure of 6.4%, as you said, the lowest that we've seen in 12 years. That would also fit in with probably the mantra that's coming out of the RBA. They are late to the party on that, and there was a lot of bigger investment banks saying very clearly that there is no doubt the mining boom is coming to an end and the slowdown is there. You're seeing, services, particularly in financial areas, which is one of the biggest employers in this country, also seeing a little bit of stagnation. Interestingly, though, the ANZ job ads has started to creep up at the back end of last year. So there is a lot of contradicting data, but what you conclude from the trend, yes, unemployment is rising, employment change is creeping down by about 5,000 jobs a month.
Well, talking about sort of that conflicting data and conflicting sentiment, industry groups turned around and said a weaker Aussie dollar is going to boost business growth, it's going to boost business investment, and that should sort of create cyclical motion and boost employment numbers. The Aussie dollar continues to sink. Why isn't that translating into those figures?
It's probably a little bit too early to sort of come to that figure yet. And the reason I say that is that if you, again, go back to the RBA and also to most of the major broker commentators on this, is that the Aussie dollar, until probably the end of last year, started this year, has really crept towards back to trend mean. So it's heading back to that 75 cent, which is the historical mean of where we normally see the Aussie dollar. At the end of last year, yes, it was down, and it had one of the worst years it's seen in basically sort of since it floated, but it was still sitting at about 85 cents. So yes, it's coming, and again, that's why these interest rate cuts are coming, is because the RBA clearly says to you that the Aussie dollar is still too high. We also have the issue around commodity prices, and yes, as much as you press down on the Aussie dollar, if the two biggest exports from this nation, being iron ore and coal, continue to plummet as well, the employment in an industry that used to be one of our biggest employers, being mining, is continuing to slow down. You're going to see that. And for instance, over the last week, you've seen Rio Tinto put a freeze on employment. There is probably a possibility you'd see that also from the other bigger players like Fortescue and BHP. So there are places that are already slowing down. As I said, the interesting one is the finance industry is also starting to slow down. You're seeing the big four that reintroduced their hiring freezes as well. Westpac had been on a hiring freeze for 2 years, removed that 18 months ago, and it sounds like they're about to do it as well. The results from CBA, although they were good, also trying to say that costs were higher in salaries, so maybe you get that as well. So employment is fickle at the moment, and it's a fairly tough market.
Will this data almost quieten those RBA critics to that cut? Does it show that the RBA were actually kind of along the right lines?
It does. I think the critic to them is justified, though, in the fact that they were probably, for a long, long time, they were very stable, very much about the idea that things, yes, they are below trend growth, but are in the level that we want them to be. They continue to see growth in certain areas, and that was all very useful as well. They were very late to the party, as I said, but the issue was the fast changing movement of the statement and the fact that they didn't foreshadow that to the market. All of a sudden, in 8 weeks, we saw a big shift in their view of growth, GDP. The biggest issue for them as well was inflation, and that gets back to the employment, because wage growth has been so flat for 14, 15 months that was clearly going to be an issue. So the critics are probably justified. The RBA was definitely behind the curve with what we're now starting to see.
So what's next then? What's the future? Your colleague Stan's already turned around and said March rate cut could be an inevitability, but economically speaking then, where are we headed?
Well, that's the question. And yes, the quote coming from my colleague Stan is clear that the interbank market shows you that there's almost a 70% chance of a rate cut in March. There's a 100% chance that we'll have it by May. So there is at least one coming according to the market, and normally in the RBA cycle you never have one. So there was guaranteed to be two, considering that history. The question now is if there's 3 or 4, and that answers the next part of your question. If we're having to cut rates to historical lows again, let's say worst case scenario 1.5%, what is that economic environment? Why are we cutting rates to that? And there's a lot of people championing the current sort of earnings season, but earnings growth shows you very clearly that it's low. EPS growth is flatlining already. You can see that even with the consumer confidence pickup we saw in the last month that's just come out, it was due to the fact that there was an initial spike to the cut and petrol prices, but it still doesn't show that we are overly optimistic. It's just on level. So there's a lot of reasons why you can see that, and I'd have to agree that at the moment mining is very slow, commodity rates are very low, employment is flatlining, wage is flatlining, and inflation is very poor. So it's disappointing. It's hard to actually sit here and tell you, look, the Australian economy for the first time looks a little bit shaky, and there is a reason the RBA is working as hard as it can. As I said, they have been late, but at least they're now finally waking up and coming to the party that there needs to be assistance in the economy.
Evan, not the most optimistic of pictures, but thank you so much for your comments. We look forward to chatting to you again soon.
Thanks, Natalie.
That's all we've got time for right now, but do click back to Dukascopy TV for more interviews from my trip down to Melbourne. For now though, it's goodbye.